The Master Trader's Journey from Casino Counters to Hedge Fund Legends. Introduction. What makes a master? Most people believe the greatest achievements come from rousing pep talks, the kind of Knute Rockne or Vince Lombardi gave. But that's wrong. The truly great performances come from a calming approach that relaxes the performer. Complex activities are best performed with only a moderate amount of emotional arousal. Think about that for a moment. When you're too excited, too nervous, too desperate to win, you fail. The greatest achievements come from controlling the focus and direction of your attention. Top traders share certain characteristics. They're bolder than ordinary traders, yet more composed. More tough-minded, self-assertive, confident, venturesome, and uninhibited. Their confidence comes from a greater ability to concentrate, to visualize, and to become centered in the course of events. They tune out distractions and focus on one thing at a time. They do this by having an overarching principle or strategy that guides their trading. That organizing principle might be as simple as, keep looking for ways to make money, or as complex as, buy the best companies and sell the worst companies. Key takeaway: mastery isn't about intensity, it's about controlled focus and the ability to remain centered while others panic. Part 1. What is mastery? Chapter 1. The Psychology of Winning. Let me tell you something that might surprise you. When I was 17, I was backpacking across Europe. In Rome, I ran out of books to read. I found a vendor at an open market, and literally the only book in English was a tattered copy of Reminiscences of a Stock Operator. That book changed everything. It starts with the protagonist just reading the tape, but that's not what he developed into. Everyone gives him tips, but the character Mr. Partridge tells him what really matters. It's a bull market. That's a fundamental macro person right there. Partridge teaches him that there's a much bigger picture. It's not just random noise making numbers go up and down. There's something else going on that makes it a bull or bear market. People get excited about price movements, but they completely misunderstand that there's a bigger picture in which those price movements happen. Price movements only have meaning in the context of the fundamental landscape. To use a sailing analogy, the wind matters, but the tide matters too. If you don't know what the tide is, and you plan everything just based on the wind, you're going to crash into the rocks. That's how I see fundamentals and technicals working together. You need to pay attention to both to make sense of the picture. The narrator of that book starts out watching numbers go up and down. I started with an interest in politics and economics. But we both ended up in places that aren't that far apart. You need to develop your own market experience. You're only going to fully understand what the great traders mean after you've done it yourself. Then you realize, oh, that's what they meant. Key takeaway: price movements only have meaning in the context of the fundamental landscape. You need both the wind and the tide. Chapter 2. The First Step. Formulating a vision. One of the first essential ideas for developing mastery is creating a concrete goal around which to frame your trading activities. This might not always seem to fit every trading style, but it's the essential first step. Once you're focused on goal setting and developing trading mastery, you can get outside yourself and begin drafting a blueprint for greater success. By creating achievable goals, you can escape the trap of cycling trading errors that intensify losses rather than reduce them. I like to meet periodically with traders in group settings because this creates momentum from shared vision and inspiration. When traders get together to discuss expectations, each talks about goals and individual strategies. This dialogue creates a sense of group cohesiveness. Here's what I ask them. Give me an idea of what you're going to do differently this year to reach your goals. One trader answered, our plan is to have 10 ideas and make $3 million in each idea over the next 12 months. How are you going to find those 10 ideas? What's changing from last year? We don't have a problem making profits. Our problem has been managing risk on losses. So we're putting a much shorter leash on those problems. Another trader said, my batting average was good. I just didn't have a lot of big losers, just a lot of winners where I could have made more money if I were bigger. What's it going to take to get bigger in those? Just do it. Double the size? Make them 50% bigger? 30 or 40% bigger? The importance of the goal is to create the stimulus for doing the kind of work necessary to produce that result. Managing your downside risk so you don't get into a hole, and sizing your positions commensurate with your goals. Key takeaway: a goal without a strategy for reaching it is just a wish. The goal creates the stimulus for doing the work. Chapter 3. The 9 dots problem. Most of us live our lives in the realm of what we know and what we know we don't know. But there's a level of mastery pertaining to what we don't know about a realm of power and extraordinary results that you discover when you step outside conventional thinking. Here's a puzzle. Connect 9 dots arranged in a square with 4 straight lines without taking your pen from the paper. Most people struggle because they consider the 9 dots to be a box, but no box really exists. The answer is thinking outside the dots. As long as you view the dots as a box, you're confined to that space and unable to complete the puzzle. When you learn to look beyond your limiting perception, you make the connection, gaining a greater sense of accomplishment and confidence. That same sense of accomplishment grows when you create a new vision or concept and then engage in activities associated with it. The issue isn't so much to realize the vision as it is to use the vision as a template for making decisions consistent with it. Such a lens releases you from the past. It allows you to live your life in terms of conscious choices. You see what you're biologically wired and socialized to perceive. You see what's already on your mental maps based on your biology and early life conditioning. When you recognize this, it becomes possible to expand what you see by expanding the number of distinctions you have. Key takeaway: the box isn't real. You create it with your thinking. Step outside your assumptions and the solution appears. Chapter 4. The Power of Not Attaching. There's a great book called Zen in the Art of Archery about a man who studied archery with a master in Japan for 5 years. At the end, he realized he didn't even have to look at the target because it wasn't about hitting the target. He could hit it with his eyes closed. It's all about being in the right position internally and allowing the arrow to be released without putting any consciousness on the release. This is how to really be in the markets, unattached. You have the goal, and you use it to get out of losses and line up profits. Then maybe you can make even more incredible profits because you're there when it's happening. One trader described this perfectly: the goal itself isn't the issue. The issue is you have a big rise, and it starts turning back on you. Are you prepared to intervene to hold a good chunk of that gain? Are you really committed to doing that? He continued, as soon as it starts going, and it looks like that goal is threatened, you intervene. As long as you're genuinely intervening to reach that goal over time, you'll be fine, because it all goes back to riding gains and cutting losses. Sometimes you need to notice that greed is getting in the way of the goal. The goal offers objectivity independent of your own emotions. That's its value. Key takeaway: the goal provides a lens for objective decision making. Detach from the outcome but stay committed to the process. Part 2. The Gambler's School. Chapter 5. The day I realized everything I knew was wrong. My first week as a junior trader at Citigroup was the week the pound got kicked out of the ERM, the exchange rate mechanism. At the time, I remember explaining to the head of the trading floor why the pound wouldn't leave the ERM. I argued it would be political suicide for the conservative government to drop out, so they'd make sure it didn't happen. My boss just smiled and nodded. Okay, we'll see. About 3 hours later, the pound crashed out of the European ERM. I felt like a complete idiot. I had absolutely no comprehension of the power of markets versus politics. The policymakers didn't understand that either. They didn't realize they weren't in control. It's not that speculators are in control either, it's that fundamentals actually matter. Fundamentally, the UK remaining in the ERM was untenable. They were in a recession with a greatly overvalued currency. Germany needed high interest rates to contain inflation after unification. Because currencies were linked, the UK was forced to maintain high interest rates even though its ongoing recession dictated the exact opposite policy. All George Soros did was recognize that the situation was untenable. The Bank of England's effort to support the pound was like trying to fight gravity. That experience taught me a huge lesson: markets matter more than policy. You have to look at real fundamentals, not at what policymakers want to happen. The willing disbelief of people can carry on for a long time, but eventually it's overwhelmed by the market. The genius of Soros was recognizing the turning point, the ability to not only know that a position was right, but that it was right now, and that now was the time to have a big risk on the trade. Key takeaway: markets matter more than policy. Policymakers aren't in control, fundamentals are. Chapter 6. The Blackjack Revelation. In December 1958, my wife and I were going to Las Vegas for a low-cost vacation. I knew better than to gamble because the odds are against you. But one of the professors in the math department told me about a new article in the Journal of the American Statistical Association that explained how to play blackjack at almost even odds. I thought I could have some fun without it costing much. I made a blackjack strategy card. When I got to the table, I sat down with 10 silver dollars. People at the table were getting clobbered because the dealer had a really good run of luck. My little strategy card, which the other players had laughed at, was doing pretty well. I was holding my own. After about 20 minutes, I got a hand with an ace and 7, a soft 18, and the dealer had a 9 showing. The strategy said hit. The other players groaned when I did. The next card was a 4, so I had 12. Then I got a string of aces and 2s, giving me 6 cards totaling 16. The strategy said hit again, and I got a 5, ace 7, card 20, 1. Now the other players got really excited. They thought the strategy card was magical. I played for a while longer and ended up losing 8 of my $10. When I went back to UCLA, I reread the article and realized there was potential for beating the game by keeping track of cards already played. The article assumed no knowledge of cards played, with all outcomes equally likely on every deal. That's the right assumption on average, but if you have more information, like what cards have been played, you can improve those odds. I became convinced that there would be significant swings in the edge back and forth. The question was how to identify those swings. Key takeaway: the house edge is just an average. With better information, you can tilt the odds in your favor. Chapter 7. The computer that changed everything. I wrote the authors of the Blackjack article, and they sent me all their lab manuals with calculations. I spent about 5 or 6 weeks mastering every detail. My plan was to repeat their calculations with some cards removed from the deck. Take out the 2s, take out the 3s, and so on. Using a desk calculator, I was making very slow progress. I estimated how long my calculations would take and discovered that if I did everything I wanted to do, it would take me several thousand years. By that time, I'd taken a job at MIT. And MIT had an IBM 704 computer, then the best commercial computer available. This was 1959. The IBM 704 was new and rare, serving 30 New England universities. As a faculty member, I could reserve time on it. I didn't know much about programming, but I developed subroutines and modularized the program, testing blocks separately before putting them together. By 1960, I started getting results back, and they were exciting. When I ran the combination of 4 aces out, the edge went to -2.5%. That implied that if there were 4 extra aces in the deck, the odds would go to +2.5%. How can you have 4 extra aces? You can't. But if you're down to half a deck and none of the aces are out, the odds are the same as a full deck with 8 aces. I could picture the blackjack probability problem as a 10-dimensional space, with the fraction of each card varying along a single axis. Any combination of cards becomes a point in that space, determined by the fraction of each card value remaining. Key takeaway: the IBM 704 did 1,000 man-years of hand calculations in 10 minutes. Sometimes technology is the edge. Chapter 8. The wearable computer. Let me take you back to 1955. I'd just gotten my master's in physics and was sitting in the dining room of the University Cooperative Housing Association at UCLA. People would gather there to take study breaks and argue about everything. Someone brought up roulette and explained why you couldn't possibly win. I said, I don't think that's true. I started a little group that faded away, but I pursued it on my own. A fellow I was tutoring bought me a half-size roulette wheel as thanks. He knew I wanted one. I bought a stopwatch that ticked in hundredths of a second. I did field experiments, setting up a movie camera on a tripod to determine how repeatable the ball motion was. The results looked pretty good. The process did seem repeatable. I also created an analog experiment, letting a roulette ball slide down an inclined track across the floor. The idea was that I could translate rotary motion into a linear equivalent. I wanted to see if the same amount of potential energy would send the ball to approximately the same place each time. It did. One night, my wife invited my in-laws over to dinner, and I was so engrossed in my experiments that I lost track of time. They came looking for me and found me rolling balls down the track. I'm sure at that moment they thought their daughter had made a very serious mistake. When I later met Claude Shannon at MIT and told him about my roulette experiments, he got very excited. We decided to work on it together. We ordered a reconditioned wheel from Vegas. I remember it cost $1,500. We set it up in Shannon's basement on a slate pool table. After several months of work, we determined we could get a huge 44% edge in roulette by predicting the most likely octant where the ball would land. Then we built the first wearable computer, now in the MIT Museum. Key takeaway: What everyone believes is impossible often just hasn't been solved yet. Keep experimenting. Part 3. The Hedge Fund Years Chapter 9. From Blackjack to Wall Street. Knowing that people were wrong about casino games being unbeatable made me stop and think. If you can beat roulette and you can beat blackjack, what else is there? The biggest game in the world is Wall Street. In 1964, I decided to spend the summer learning about the stock market. I read everything from barons to books like The Random Character of Stock Prices. Most books were helpful in the negative. They convinced me which roads not to go down. That summer, I came across a publication called RMH Warrants and Low Price Stock Survey. I realized that the pricing of warrants should be mathematizable. The huge number of variables that might apply to forecasting stock prices were almost all eliminated if you focused on warrants instead. I wrote down a short list of factors that should determine warrant price: the price of the underlying stock, the strike price, volatility, time to expiration, and interest rates. The same factors everyone today agrees determine option prices. When I transferred to the University of California at Irvine that fall, the head of the School of Information and Computer Science told me there was someone else at the university working on the same thing. That person was Sheen Kassouf, who'd already written a thesis containing a theoretical model for warrant prices. We started working together, which ultimately led to co-authoring Beat the Market. Why would I write a book telling people how to price warrants and find mispriced trade opportunities? We answered that in the book. We thought it was only a matter of time before others made similar discoveries. If we were first to write about it, prospective investors would read the book and come to us. Key takeaway: ideas don't appear in just one place. Newton and Leibniz both discovered calculus, Darwin and Wallace both discovered evolution. Being first to publish matters. Chapter 10. The birth of a hedge fund. In 1967, I developed an option pricing model that was equivalent to the future Black-Scholes formula. I started using it that year. The formula was good enough that when I sold naked short warrants, without a hedge, during the huge bull market of 1967-68, I still broke even on those positions. That formula really proved itself. As far as I know, those short warrant positions were the first actual application of the Black-Scholes formula in the markets. Black and Scholes discovered it in 1969 and published in 1972-73. The option pricing formula seemed like a big edge on everyone else, so I was happy just to use it. By 1969, I'd started my first hedge fund, Princeton Newport Partners. I thought if I published the formula, I'd lose the edge helping my investors. Once Black and Scholes published, it was too late. I have no regrets. On my first day at UCI, word got out about our warrant trading. People started asking me to manage their money. Before long, I had a dozen accounts and a lot of happy people on campus. The theme in Beat the Market was that warrants with less than 2 years to run typically traded at premiums that were too high. The typical trade was to short the warrant and hedge by buying the stock. Kassouf and I had different ideas about how to implement the strategy. He thought he could tell something about stock direction and would sometimes take a fundamental view. I was afraid to do that because I didn't believe I had any forecasting power. I thought we should always hedge to be delta neutral. So we went our separate ways. Key takeaway: even among successful traders, style differences matter. Find what works for you, not what works for someone else. Chapter 11. Meeting Warren Buffett. When I started managing accounts trading warrants at UCI, I got a reputation around school. One person who heard about me was Ralph Gerard, dean of the graduate school. He happened to be an investor with Buffett Partners Limited, which was being closed down because Buffett felt stocks were at crazy heights in 1968. Gerard needed an alternative investment for money he was getting back from Buffett. He introduced me to Buffett, and we played bridge at Gerard's house a few times. I knew Buffett was a really smart person when I met him in 1968. I remember telling my wife that given his ability to analyze companies, his rate of compounding, and the scalability of his approach, I thought he'd become the richest person in the U.S. someday. He was, for a period a few decades later. I lost track of Buffett, and then one day in 1982, I learned that Berkshire Hathaway, the company whose stock he'd been distributing in 1968, had been turned into his own private mutual fund. I immediately realized what that meant. So I went out and bought Berkshire Hathaway shares. They'd been selling for 12 a share in 1964, and here I was buying the MAT 12 a share in 1964, and here I was buying the MAT 985 a share. When I asked Buffett if he knew about 3 oddly numbered dice, he was interested. Like standard dice, each face has a number between 1 and 6, but unlike normal dice, some numbers repeat. These dice are used for a gambling game. You pick the best die, then from the remaining 2 I pick the second best. We both roll, and the high number wins. I can beat you on average even though you chose the better die. The surprise is that there's no best die. Call them A, B, and C if A beats B, and B beats C. You'd think A should beat C, but instead, C beats A. This puzzles people because they expect the transitive rule. If you replace better than with longer than, heavier than, older than, the rule holds. But some relationships don't follow this rule. If we replace better than with beats on average, these dice are non-transitive. The childhood game of rock, paper, scissors is a simple example. Rock beats scissors, scissors beats paper, and paper beats rock. Another non-transitive example with great practical impact is voting preferences. Often a majority prefers A over B, B over C, and C over A who gets elected. It depends on the election process. Kenneth Arrow won the Nobel Prize for showing that no voting procedure exists that satisfies all intuitively natural desirable properties. Key takeaway: the market doesn't always follow transitive logic. Sometimes A beats B, B beats C, and C beats A. Stay flexible. Part 4. The Crisis. Chapter 12. When the world breaks. The roots of the 2008 crisis go back to the aftermath of the internet bubble correction of 2009-11. To prevent a deepening recession, the Federal Reserve cut interest rates to historic lows, in mid-2003, to 1%. This meant holding money in a bank was expensive, while getting a loan was cheap. Especially cheap to get a housing loan. Meanwhile, in China, a fantastic economic boom was underway, accompanied by a government policy of high savings and low consumption. Chinese workers were paid very little. The government took profits and invested them in American Treasury bills, bonds, and stocks. China's savings were parked in the United States, and it was incumbent on us to spend them. In mid-2005, median home prices in the United States finally began to decline. This was properly the beginning of the crisis. But it first hit the news in July 2007 when 2 Bear Stearns hedge funds that had invested heavily in mortgage-backed securities went under. 2 separate but related problems became visible. First, holders of subprime mortgages were going to start defaulting at higher than predicted rates. Second, the owners of those mortgages were no longer the original lenders. They'd bundled them and sold them to banks and hedge funds. The question was whether the problem could be contained. President Bush held a press conference in late August to assure Americans that homeowners wouldn't be left defenseless and that the housing crisis could be isolated. The recent disturbances in the subprime mortgage industry are modest, he said, modest in relation to the size of our economy. When asked about hedge funds and banks overexposed to the subprime market, Bush blinked, said, "Thank you," and turned to leave. Key takeaway: the seeds of the 2008 crisis were planted in the early 2000s. Low interest rates, Chinese savings, and deregulation. Chapter 13. The Death of Bear Stearns. It's been a really turbulent couple of weeks. I've been doing this for over a decade, and I've seen asset prices more distressed than today. The particular market I trade, I've seen much more distressed. But I've never seen the financial system as a whole more distressed. The sense of panic and despair at the major banks, I've just never seen it before. Bear Stearns was a bank that was very involved in the asset-backed and subprime market, both as a principal and as an agent. Funds managed by Bear Stearns, not their own books, but other people's capital, were heavily leveraged and invested in asset-backed securities. Those funds blew up. They failed very quickly. One day they were there, the next all assets were marked down, then they were insolvent and folded. From that moment forth, people speculated about how many similar assets Bear Stearns must own on its own books. There was a cloud of suspicion. Once there's a cloud of suspicion, the information asymmetry between people outside the firm who don't know what's going on and inside the firm can create a crisis of confidence. What are they going to do? Show you every instrument on their books? People don't know what these instruments are worth. An asset-backed bond, what's it worth? Nobody knows. There isn't a market for this anymore. It's not like there are 3 bond issues, there are thousands, each backed by thousands of mortgages. You simply can't prove in a reasonable amount of time that everything's fine. Bear was involved in a lot of asset classes that had problems. First subprime mortgages, then leveraged loans. They were exposed to all these things, 30 times leveraged, so a very small drop in asset values could mean their equity was worth nothing. A lot of wealth was wiped out. The strange thing about the deal was that Morgan was paying so little for Bear Stearns. Bear had been trading at 170 a share not that long ago. Now the deal was 170 a share not that long ago. Now the deal was 2 a share. The reason the Fed didn't want Bear to go through bankruptcy was the interconnections, counterparty risk that could lead to panic and a whole mess in the financial market. The Fed just wanted the problem to go away. But if I'm a shareholder, it's not my problem. Let's go bankrupt. Maybe we can do better than $2. The theory was that the Treasury Department went to Bear's top guys and said, either a deal gets done that saves Bear and calms the financial system by the end of this weekend, or we'll find some reason to put you in jail. Post Enron, every officer of a public company is very sensitive to jail. There's been a criminalization of failure. After Sarbanes-Oxley and prosecutions related to business failures, it was like Beria said, you show me the man, I'll find the crime. Key takeaway. Bank runs aren't triggered by rational calculation, they're triggered by fear, and fear spreads faster than any virus. Chapter 14. Zombie banks today, where people have made bad investment decisions, where people built houses they never should have built, there's a misallocation of resources. The loss has already happened. The loss isn't what happens on a balance sheet, the loss is when someone cuts down a tree, makes cement, and builds a 6,000 square foot house in a place it should never be built. The question is, how do you allocate that loss? If you don't allocate the loss, if you pretend it isn't there, this has really baleful consequences for the economy. What we're going through now is this process of loss allocation. It can be done swiftly, fairly, and intelligently, or it can be done slowly, messily, and inefficiently. If it's happened, the best is to deal with it swiftly and fairly. When shareholders get hurt really badly and banks have to recapitalize at punitive levels, or get taken over at $2 a share, I think it's fair. The banks made bad decisions. The equity holders are the prime beneficiaries of bank activities. When things go poorly, they should be the primary bearers of loss. If you don't allocate the loss, you have zombie banks, like in Japan after the crash of the early 90s. The bank has a loan to a company that's clearly insolvent. The bank should be restructuring, but it doesn't want to admit insolvency. So it doesn't restructure. They're like the undead. Otherwise we have these zombie banks that can't lend, zombie companies that shouldn't exist, and resources that should be released aren't being released. I was just in Florida visiting family, and it was amazing to see all the new housing that had been built that's just empty. I was visiting relatives in a relatively upscale property development in South Florida that's 2,500 homes. The initial phase sold out quickly, and many people who lived there decided to invest in the last phase of development and buy units to resell. It's like a movie set. It's like a neutron bomb went off. There's no one there. Key takeaway. Losses must be allocated, not hidden. Zombie banks and zombie companies only delay the inevitable and make it worse. Part 5. The Psychology of Risk. Chapter 15. Your internal map. Hamlet was right. There is nothing either good or bad, but thinking makes it so. Much of the meaning you attach to events comes from projecting your own unconscious thoughts and feelings onto those events. Your past experiences created the thoughts, what I call life principles, that dominate and distort what you experience in the present. You derive meaning not from the experience before you but from a replay of the past. The theories you use to explain your experience are less valid than you suppose. You bring a set of life principles from the past to all situations. They color your expectations, perceptions, and reactions. What you see does not mean what you initially believe it means. In fact, what you see may actually be beyond your comprehension. I realize this may strike you as a profoundly disconcerting idea, and I'm not asking you to believe it just because I'm saying it. What I do ask is that you give it a chance. Look at the world as if this were true, that what you see is colored by the lens of your past experiences and that you cannot see reality as it is until you recognize the existence of this lens. Consider how a trader's life principles activated his fears. Hayden, a biotech trader, began losing money one morning. He soon felt anxious about losing money. His hands became sweaty. A headache crept into his temples. His heart beat faster. He decided to sell, not based on any real work determining whether there were good reasons for the price to fall, but on fear and anxiety about the falling price. An hour before the close, the stock inched up again. By then, his head was pounding and he was in complete panic. Unfortunately, the sale Hayden made exemplifies an all too common process. He was acting on feelings rather than on objective data. The task of coaching a trader like Hayden is to get him to stand back from his emotional reaction, to think through the trade independently of his own emotionality, and to consider what work might fortify his conviction to stay with the trade or get out. The critical thing is to learn to ride out the anxiety, to not view the trade through the lens of your own emotional reactivity. Key takeaway: your feelings aren't facts, they're data, but they're not the trade. Learn to ride out anxiety without acting on it. Chapter 16. The source of all fears. Your biggest obstacles to mastery are the inhibitions, fears, and fantasies about yourself that form the basis of your life principles. These concepts are like tapes from your past that replay over and over, keeping you locked into repetitive responses that prevent you from empowering yourself. You cause conflict by reacting to events in terms of past interpretations rather than present reality. A first step in shedding life principles is acknowledging how vulnerable you are to these defensive reactions. When you can admit your anxiety, your uncertainty, your mistakes, you have less need to hold fast to those defenses. You've relied on them to give you control, but they now stand between you and your commitment to mastery. Once you bring these life principles to the surface, you can start letting go. Notice when you're inclined to rationalize inaction or failure, when you retreat to obsessive thinking, or when you become too attached to results. You also keep anxiety alive by interpreting your feelings negatively. Feelings are what they are. How you interpret them often comes from a perspective distorted by your past. Separate your old, no longer useful thoughts from current events. Allow events to be. Wait for those defensive thoughts and physical sensations to pass. Your reactions will fade. When something unpleasant happens, notice your thoughts, your opinions, your reflexive decisions, but don't let them hook you. Consider alternative ways to view the event. The more you do this, the more skilled you'll become and the less habit-ruled you'll be. Part of anxiety stems from being afraid to see things in a new light. You're moving into a realm of uncertainty. Embrace it. Don't let ghosts from the attic of your past scare you. Key takeaway: you are not your thoughts. Observe them, let them pass, and make decisions based on reality, not the echo of past trauma. Chapter 17. Riding out anxiety. Anxiety is a normal result of trading large sums of money in a volatile, unpredictable environment. It's the most common emotion in day trading. Like pain in the human body, anxiety can be helpful if viewed appropriately. A person who doesn't experience pain can be in grave danger and never know it. Imagine a woman going into labor without contractions to indicate it's time for the maternity ward. Pain is an indicator that something needs attention. Anxiety is a natural reaction to stress. Although it sometimes leads to trading errors, overcautiousness, impulsivity, perfectionism, withdrawal, you must recognize the anxiety and the resulting problematic reactions. You do this by learning to calm down, reassess the trading situation, and make the most objective decision possible. The master trader uses his own emotional states to help gauge market nature and determine what moves other traders will make. He doesn't turn off his emotions but trains himself to handle them as indicators, as context clues to help reach his trading goal. The activation of emotions indicates that he's more fully engaged, creating challenges for himself, putting himself at risk in terms of trying to discover what he must do to accomplish the task before him. When you begin experiencing anxiety, make a note of it. Jot down the day and time, what you're feeling, and why. Then wait. Make note of when those anxious feelings subside. By keeping a written log, you document the changing nature of your experiences. You'll begin to understand that emotions, regardless of whether they're pleasant or unpleasant, are always transient. Anxiety will abate over time. The key to mastery is learning to make trading decisions irrespective of your emotional state, never allowing it to pull you out of your game or unjustifiably distract you from your predetermined course of action. Key takeaway: anxiety isn't the enemy, reacting to it without thinking is. Time your anxiety, watch it pass, and trade through it. Chapter 18. The Golden Dollar. Let me tell you about a mental trap I call the Golden Dollar. There's a mental state I get into where things are starting to go my way and I feel intellectually validated. This is fantastic. I get into a slightly euphoric state. It's exactly the wrong thing. In the past, I sold a lot more down near the bottom. I've improved somewhat, but even selling a little here throws my rhythm way off. I have to pay attention to my gut instinct. I have to know when that little guy in my head jumps up and says, "I am the greatest in the world." I have to kick him in the head. I have to do the opposite of what I feel I want to do. When I get up here, I'm going to feel so fantastic about myself that I'll double down. It's not the dollars I'm going to miss. It's that the dollars between the low point and the lowest point feel worth 10 times the dollars from the top to the low point. I know that's not really so, but it feels that way. It's the intellectual satisfaction. Now I'm going to bask in the glory. I got there first. I know it. I'm right, and they're wrong. Once I get to that point, every dollar beyond that is glory money. It's an experience I can't even describe, but it's my enemy because I always want this. I fear missing this. I'm not thinking rationally. Panic is when I should liquidate. If you sat me down and said, "You're in the money, what do you do?" I'd say, liquidate, because they all want my stuff. I don't want to wait until the panic is over. Then people will realize they overdid it, and the panic created its own price. I don't logically want to be there, but when I'm on the right side of the position, it's really hard to force myself out. On average, if I give myself 3 months, 6 months, or a year, I'll get many more times where this happens, or it bounces up, and I'll get a better chance to enter the trade. As I said, this dollar is emotionally worth 10 times more than any other dollar I make. That's why I don't do what I know I should. Key takeaway: the last dollar before a reversal feels 10 times more valuable than any other dollar. That feeling is exactly when you should take profits. Part 6. Strategy and Structure. Chapter 19. The Holy Grail of Investing. Let me show you what I call the Holy Grail of investing. If you draw a chart where the horizontal axis represents the number of investments and the vertical axis the standard deviation, risk, you'll see that as you add assets, portfolio volatility decreases. But here's the key. If you add assets with a 0.60 correlation to your other assets, risk will go down by about 15%, and that's it, even if you add 1,000 assets. If you run a long-only equity portfolio, you can diversify to 1,000 stocks and only reduce risk by about 15%, since the average stock has about a 0.60 correlation to another stock. If, however, you're combining assets with an average of 0 correlation, by the time you diversify to only 15 assets, you can cut volatility by 80%. Therefore, by holding uncorrelated assets, you can improve your return-risk ratio by a factor of 5 through diversification. But what about the problem of markets becoming highly correlated? If you tell me the S&P is down 2%, I can tell you the direction of virtually every other market, right? I don't think that's correct. I can't tell you which way the Greek-Irish bond spread would move in response to the S&P being down. There are ways to structure trades so you can produce a whole bunch of uncorrelated bets. I strive for approximately 100 different return streams that are roughly uncorrelated. There are cross-correlations that enter into it, so the number works out to less than 100, but it's well over 15. Correlation doesn't exist the way most people think it exists. People think there's a thing called correlation. That's wrong. What's really happening is that each market is behaving logically based on its own determinants, and as those determinants change, what we call correlation changes. For example, when economic growth expectations are volatile, stocks and bonds will be negatively correlated. If growth slows, both stock prices and interest rates decline. But when inflation expectations are volatile, stocks and bonds will be positively correlated. Higher inflation is detrimental to both. Both relationships are totally logical, even though they're exact opposites. If you try to represent the stock-bond relationship with one correlation statistic, you deny the causality of the correlation. Key takeaway: correlation is a symptom, not a cause. Understand the drivers, not just the numbers. Chapter 20. Testing your strategy. We spend a lot of effort to avoid getting into situations where we're losing money without knowing why. You want to design a portfolio that will survive a 150-foot tidal wave. The number one risk factor for me is leverage. At extreme levels, our net exposure is usually less than a typical mutual fund's. One reason I didn't take more exposure off in 2008 was that I was only about 75% net long. Virtually every mutual fund on the planet is close to 100% long. So what's the big deal? For many people, risk control means they have a plan for what to do if something goes very wrong. I try to avoid getting into that situation in the first place. Our defining moment of a survival threat is being down more than 7% in a month and not knowing why. If you look at our fund's history, 90% of monthly returns were between plus 7% and 7%. So if a monthly loss is less than 7%, we're still in a normal range. If a loss exceeds 7%, something is wrong. If I can figure out what's wrong, I might not change anything. If I can't figure it out, I have to reduce exposure. But losing money on the long side is different from losing it on the short side. On the long side, there's a limit to how low prices can go. On the short side, risk is open-ended. Also, from the client's perspective, during the fourth quarter of 1999 when the market was skyrocketing and I was net short, I was losing while most other hedge funds made a ton of money. When your investors see that, they're much more likely to pull their investment. Being short in a rising market is very difficult from an investor relations standpoint. In 2008, we were losing money, but so was everyone else. It's much easier to keep your capital base in that scenario. Key takeaway: risk management isn't just about controlling losses, it's about surviving the scenarios where your approach looks wrong. Chapter 21. The Kelly Criterion. The Kelly Criterion is the fraction of capital to wager to maximize compounded growth. Even when you have an edge, beyond some threshold, larger bets will result in lower compounded return because of volatility's adverse impact. The Kelly Criterion defines this threshold. The formula is F equals PW, PL, W, where F is the fraction of capital to bet, W is $1 per dollar wagered, PW is probability of winning, and place is probability of losing. When win size and loss size are equal, the formula reduces to F equals PW, plural. If a trader loses 1,000 on losing trades and gains 1,000 on losing trades and gains 1,000 on winning trades, and 60% of trades are winners, the optimal trade size is 20%, 0. 60 to 0. 40 equals 0. 20. Proportional overbetting is more harmful than underbetting. Betting half the Kelly criterion will reduce compounded return by 25%, while betting double the Kelly will eliminate 100% of the gain. Betting more than double the Kelly will result in an expected negative compounded return, regardless of the edge on any individual bet. I learned about the Kelly criterion from Claude Shannon back at MIT. Shannon had worked with Kelly at Bell Labs. When Kelly wrote his paper in 1956, Shannon refereed it. When I told Shannon about my blackjack betting system, he told me to look at Kelly's paper for deciding how much to bet. The Kelly criterion of what fraction to bet seemed like the best strategy over the long run. When I say long run, a week playing blackjack in Vegas might not sound very long, but I'd be placing thousands of bets in a week. I'd get to the long run pretty fast in a casino. In the stock market, it's not the same. A year of trades won't be a long run. But there are situations in the stock market where you get to the long run pretty fast. For example, statistical arbitrage, where you place tens or hundreds of thousands of trades in a year. If you can calculate the probability of winning on each trade and the ratio of average win to average loss, the Kelly criterion will give you the optimal fraction to bet so your long-term growth rate is maximized. For betting in casinos, I chose the Kelly criterion because I wanted the highest long-term growth rate. There are, however, safer paths that have smaller drawdowns and a lower probability of ruin. Key takeaway: bet too little and you leave money on the table. Bet too much and you guarantee failure. The optimal bet size is a precise calculation. Chapter 22. Implementation matters more than ideas. Having a beautiful idea doesn't get you far if you don't do it the right way. Implementation is more important than the trade idea behind it. The point is to do trades in a way that timing doesn't have to be perfect. For example, after money market liquidity dried up in August 2007, I expected rates to be cut. Instead of expressing this only through long-short-term rate instrument positions, I also implemented as a yield curve spread, long-short-term rates, short-long-term rates. Why? The yield curve was flat at the time. If rates declined, the decline would be concentrated on the short-term end. If rates went up, long-term rates would go up at least as much as short-term rates, and probably more. The spread provided most of the profit potential with only a fraction of the risk. The Nasdaq peak provided another example. After the March 2000 peak, I felt fairly certain the bubble had burst. Yet I didn't consider short positions in Nasdaq because trading the short side was treacherous. Even though the market ultimately went sharply lower, in summer 2000 the index rebounded approximately 40%. A move that large would likely have stopped out a short position. Instead, I reasoned that a Nasdaq top implied that most assets would recede from inflated levels, leading to an economic slowdown and lower interest rates. A long bond position provided a much easier and comfortable way to trade the same idea. Bonds subsequently witnessed a fairly smooth uptrend, in contrast to the highly erratic downtrend in Nasdaq. Flexibility is essential. It's important not to get attached to an idea and to always be willing to get out if price action is inconsistent with your hypothesis. George Soros is a master of flexibility. He has no attachment to his trades and shows the least regret about getting out of a position of anyone I've ever met. In April 2009, I was very pessimistic about the financial outlook, but market behavior told me I was wrong. Since my bearish hypothesis was inconsistent with market price action, I formulated an entirely different hypothesis that seemed to fit what was happening: an Asia-led economic recovery. Staying with my original expectation would have been disastrous. The flexibility to recognize my premise was mistaken and to act on that awareness allowed me to have a profitable year, even though my original market outlook was completely wrong. Key takeaway: how you trade an idea often matters more than the idea itself. Implementation is everything. Part 7. The Master's Mindset. Chapter 23. Mistakes are the path forward. I learned that there's an incredible beauty to mistakes because embedded in each mistake is a puzzle and a gem that I could get if I solved it, a principle that I could use to reduce my mistakes in the future. Each mistake was probably a reflection of something that I, or others, was doing wrong. If I could figure out what that was, I could learn how to be more effective. While most others seem to believe that mistakes are bad things, I believe mistakes are good things because most learning comes from making mistakes and reflecting on them. At Bridgewater, we've codified this in our principles document. A few of the rules: recognize that mistakes are good if they result in learning. Create a culture where it's okay to fail but unacceptable not to identify, analyze, and learn from mistakes. Bring mistakes into the open and analyze them objectively. Highlighting them, diagnosing them, thinking about what should be done differently, and adding that new knowledge to the procedures manual are essential to improvement. Recognize that you will certainly make mistakes and have weaknesses, and so will those around you and those who work for you. What matters is how you deal with them. If you treat mistakes as learning opportunities that can yield rapid improvement if handled well, you'll be excited by them. If you don't mind being wrong on the way to being right, you'll learn a lot. People who blame bad outcomes on anyone or anything other than themselves are behaving in a way that's at variance with reality and subversive to their progress. Key takeaway: mistakes aren't failures, they're data. Each one contains a lesson that can make you better if you're willing to find it. Chapter 24. Finding your variant perception. In order to make money, you have to be able to ask what's wrong with what everyone is telling you. You have to consider where conventional thinking is incorrect. This takes thoughtfulness and perception. You have to be able to be critical and say something is wrong. I call this the variant perception, having a unique piece of data, an edge, that gives you a differentiated view. For example, everyone says, the sky is blue. You say, the sky doesn't stay blue forever. It turns gray. They ask, how do you know it turns gray? It turns gray every night. Oh, we think it will always be blue. When will the sky turn gray? The sky turns gray at 6 o'clock. Now you can short this sky at 5:50 because you know that at 6 o'clock, everyone who said blue will now see gray. What's so hard about getting the variant perception that makes it masterful? Most people are consensus thinkers. They're afraid to think originally. If a company's stock is going up, they think it must be great. The variant perception is recognizing that a prominent company is really bad. The master trader is looking for what he thinks is the most powerful thesis for the moment. He's continually vetting data and perspectives from people approaching the same companies with different viewpoints. He's looking at different styles and, in effect, playing the different people in the room as well as friends and colleagues at other firms. He watches these people, and they give him insight into how the world looks. So one form of mastery is to surround yourself with talented people, encourage them to play their game, and observe what they're experiencing. Watching them trade provides insight into what parts of the market are working and what styles are working. The master knows who the long players are. He knows the guys who will capitulate. That's a critical part of his overall trading strategy. It provides significant psychological input. Key takeaway: the variant perception is seeing what others don't. and having the courage to act on it before they do. Chapter 25. Doing nothing is doing something. One of the best ways to outperform most investors and grow your wealth is based on a simple concept that all investors should understand. Consider a mutual fund that buys every stock trading on a major U.S. exchange, investing in each company a percentage equal to its percentage of total market value. This fund behaves like the entire market, with the same daily percentage changes and dividend payouts. This is an index fund. Call any investment that mimics the whole market passive. If these passive investors together own, say, 15% of every stock, then everybody else owns 85%, and, taken as a group, their investments also act like one giant index fund. But everybody else means all the active investors, each with their own recipe for how much to own of each stock. As Nobel Prize winner Bill Sharp says, it follows from the laws of arithmetic that the combined holdings of all active investors also replicate the index. Before costs, each passive investor gets the same return as the index. This is also true for active investors as a group, but not for each individual. Holding a larger percentage than the index in some stocks and less in others, they may do better or worse than the index in various periods. Their individual returns are statistically distributed around it, with most fairly close and some quite different. They have more risk without the expectation of more return. Active investors as a group trade more than 100% of their portfolio per year. This imposes substantial costs from commissions and market impact. Investors who don't index pay on average an extra 1% a year in trading costs and another 1% to helpers, money managers, salespeople, advisors, and fiduciaries. As a result of these costs, active investors as a group trail the index by about 2%, whereas the passive investor who selects a no, load, low, expense ratio index fund can pay less than 0.25% in fees and trading costs. If the index beats the pool of active investors by 2% each year, does that mean it also beats most equity mutual funds? Widely publicized year-end reports show the S&P 500 beating a majority of mutual funds most years, but not always. Why? We're comparing apples and oranges. The S&P 500 isn't the whole market. It doesn't include most small companies. Still, the benefits from indexing are substantial. After costs and inflation, tax-exempt passive investors gain 6.7% annually compared with 4.7% for actives, 1/3 more. After taxes, it's 2.0% for actives versus 4.8% for indexers, more than double. Key takeaway: for most people, the best way to beat most investors is to stop trying to beat the market, just own it. Chapter 26. How much is enough? The famous American fiction writer John D. MacDonald characterized levels of wealth in 1970 in his Travis McGee series. His economist co-hero Meyer said 100,000 was adequate, 100,000 was adequate, 250,000 comfortable, 1 million inches substantial, and 1 million inches substantial, and 5 million impressive. Adjusting for inflation to $2015, 600,000 adequate, 600,000 adequate, 1,500,000 comfortable, 6 million substantial, 6 million substantial, 30 million impressive. U.S. household wealth was estimated at $83 trillion at the end of 2014, mainly stocks, bonds, real estate, and personal property. If we divided uli among 320 million people, each would have about $83 trillion at the end of 2014, mainly stocks, bonds, real estate, and personal property. If we divided among 320 million people, each would have about 270,000. However, this national wealth has become more unevenly distributed. The median wealth of a U.S. household fell 36% after inflation from 2003 to 2013, declining from $88,000 to $88,000 to $56,000. In contrast, a household at the 97.5 percentile was 12% better off, with net worth moving from $19 million to $19 million to $36 million. Some of the super rich call $100 million a unit. When they have their first unit, they proudly announce that the first unit is the hardest. At the top of the ladder is Bill Gates, whose fortune at one point exceeded 1% of the entire U.S. gross national product. One of the keys to reaching such great wealth is compound growth. Compound interest, described as the eighth wonder of the world, has built great fortunes, and you can use it to get richer. Consider two investors. Sam starts with 1. Each time it doubles, Hepacheese 1. Each time it doubles, Hepacheese 1 profit in a sock instead of reinvesting. After 10 doublings, Sam has a profit of 1 times 10 plus is original 1 times 10 plus is original 1. Total $11. Charlie also starts with 1 and makes the same investments but lets his profit ride. His 1 and makes the same investments but lets his profit ride. His 1 becomes 2, 2, 4, 8, until after doubling she has 8, until after doubling she has 1024. Sam's wealth grows as 1, 1, 2, 3, 3, 11. This is simple growth, arithmetic growth, growth by addition. Charlie's increases as 1, 1, 2, 4, 4, 1024. This is compound, exponential, geometric, or multiplicative growth. Over a sufficiently long time, compound growth at a small rate will vastly exceed any rate of arithmetic growth, no matter how large. Key takeaway: compound growth is the 8th wonder of the world, but only if you let your profits ride instead of taking them off the table. Chapter 27. Life after the crisis. Let me tell you something about hedge funds. The idea that you're getting the best investment talent, the best risk management, because you're paying a lot more than you would for a mutual fund, took a hit in 2008. If hedge funds have a high probability of spectacular blow-up, that makes them a less attractive asset class. Number 2. People invest in funds that farm out money to several hedge funds on the theory that each has its own investment strategy and returns won't be correlated. But what we saw in 2008 was a high degree of correlation. If I thought I'd benefit from diversification by investing in multiple hedge funds, but I'm not. In fact, there's a hedge fund factor underlying the performance of all these funds, so in bad times they can be much more correlated than I thought. Then money might leave the asset class. I do worry about the hedge fund business. It may wind up being a much more difficult business going forward. You've had a number of high-profile fund blowups in recent months, funds that either endured very large losses that jeopardized their existence or blew up completely. That damages the credibility of the asset class. People who invest in hedge funds have thought of it as an asset class that would be robust in any environment. But the outcomes of some of these funds give the lie to that belief. So what may happen is that even if we perform better than the average hedge fund, if everyone is down 10% and you're up 1%, you may have outperformed everybody, but the structural damage to the asset class is so large that it doesn't matter. Money will be pulled out of hedge funds. As the economy slowly recovers and the market bounces back to new highs, investors forget what happened in 2008-09. By 2015, hedge fund assets reached a new high of $2.9 trillion. Management fees ranging between 1.5 and 2% delivered $2.9 trillion. Management fees ranging between 1.5 and 2% delivered $50 billion to operators. Their percentage of profits added perhaps another $50 billion. This $50 billion in performance fees supposed LY represents 20% of profits after all other charges. BUT investors ASA Group actually pay a larger percentage. Supposed two funds start the year at $50 billion in performance fees. Supposed LY represents 20% of profits after all other charges. BUT investors ASA Group actually pay a larger percentage. Supposed two funds start the year at $1 billion each. One nets $300 million and the other loses $300 million and the other loses $100 million. At 20% of profits, the first fund collects $60 million and the second collects none. Pooling results: investors pay $60 million and the second elect 10-1. Pooling results: investors pay $60 million on a profit of $200 million, a rate of 30% of combined gains and losses. Key takeaway: hedge funds charge premium fees for the promise of uncorrelated returns, but in a crisis, correlations all go to 1. Epilogue: what I've learned: education has made all the difference for me. Mathematics taught me to reason logically and to understand numbers, tables, charts, and calculations as second nature. Physics, chemistry, astronomy, and biology revealed wonders of the world and showed me how to build models and theories to describe and predict. This paid off in both gambling and investing. Education builds software for your brain. When you're born, think of yourself as a computer with a basic operating system and not much else. Learning is like adding programs, big and small, from drawing a face to riding a bicycle to reading to mastering calculus. You'll use these programs to make your way in the world. Much of what I've learned came from schools and teachers. Even more valuable, I learned at an early age to teach myself. This paid off later because there weren't any courses in how to beat blackjack, build a computer for roulette, or launch a market-neutral hedge fund. I found that most people don't understand the probability calculations needed to figure out gambling games or solve everyday problems. We didn't need that skill to survive as a species in the forests and jungles. When a lion roared, you instinctively climbed the nearest tree and thought later about what to do next. Today we often have the time to think, calculate, and plan ahead, and here's where math can help us make decisions. One of my great pleasures from studying investing, finance, and economics is discovering insights about people and society. The physical sciences have rules like the law of gravitation that generally hold true. But human beings and the way they interact aren't covered by broad, unchanging theories and may never be. Instead, I've come across more limited concepts that tie things together and serve as shortcuts to understanding. Charlie Munger presents his list of such thinking tools in Poor Charlie's Almanac. This multidisciplinary collection of insights includes a favorite of mine for understanding deals and relationships: look for the incentives, which is closely related to cui bono, or who gains. Cui bono instantly explains why 7,000 U.S. gun dealers lining the border with Mexico are allowed to provide nearly all the military-level arms used by Mexican drug cartels. It explains why Congress mandated the wasteful folly of corn-based ethanol. To preserve the quality of my life and to spend more of it in the company of people I value and in exploration of ideas I enjoy, I chose not to follow up on a number of business ventures, although I believe they were nearly certain to become extremely profitable. Once I worked out the major concepts in a subject and proved them in action, I liked new mental challenges, moving from gambling games to the investment world, then to statistical arbitrage. Starting as a university professor, I expected to spend my life teaching, doing research, and talking to smart, like-minded people. But from childhood I was intrigued by the power of abstract thinking to understand and direct the natural world. When I later saw how physics could predict roulette outcomes through the fog of chance, and mathematics could tip the odds in blackjack, I was drawn into a lifetime of adventure. It was my good fortune to share most of this journey with a remarkable companion. My wife, Vivian, loved books and was a voracious reader. One year we kept a journal about the books we read. In 12 months she cruised through more than 150 books at 700 words or more per minute. She passed on her love of books to our children and grandchildren. After she died from cancer in 2011, we celebrated her life with a memorial service. When I think of our lives together, I remember what her brother said: "Nobody can take away the dance you have danced." Life is like reading a novel or running a marathon. It's not so much about reaching a goal but rather about the journey itself and the experiences along the way. As Benjamin Franklin famously said, "Time is the stuff life is made of, and how you spend it makes all the difference." Best of all is the time I have spent with the people in my life that I care about: my wife, my family, my friends, and my associates. Whatever you do, enjoy your life and the people who share it with you, and leave something good of yourself for the generations to follow. Final takeaway: the ultimate measure of success isn't wealth. It's the quality of the time you spend and the people you share it with.